Okay, good morning. A very good morning to everybody. It is Wednesday. It is 9 o'clock in the morning. It's very cold and wet and windy outside. I want to say hello. If you're coming on the live stream, say hi, introduce yourself. If you're coming through the Assets for Freedom Facebook group, there's a little link. You need to click on the post that will effectively reveal who you are, so you can say hello and we can interact. If you're on YouTube, a very good morning to you and welcome to this live stream. Now, I want to explain a little bit before I dive into that. Well, in fact, before I do that, I'm going to tell you what I will talk about today, which is an update on the housing market. We've had UK HPI, House Price Index, out for January. Interesting figures. This goes in line with what I talked about last week with inflation and interest rates. So I do these lives because they're a lot easier than creating a standalone video. And we can go live. I want to go live weekly to be able to sort of talk about what's going on in the market, what factors we need to look at, what are going to influence your buying decisions. And it's a good chance for us all to jump on a live, you ask any questions, because I'm looking to create a community here, not just put out videos that people watch, but an actual community that we can help each other build our businesses, whether you're in business, whether you're in property, whether you're in a job and you're looking to get out. And on that note, I'd like to say hello to all the new subscribers. Look, we've only been building this channel and this group for a month or so. We've had a lot of new subscribers over the last week. So welcome to you, and it's great to have you here. So as you do come on, please say hello. So we can interact. And if you've got any questions we go through, I'll dive into the questions every now and again, see what there is, and we can have a chat about it. I'm also going to cover some of the stuff I did on last week's live because we had some sound issues last week. I apologise about that. I've got some new kit that I'm working with and working out. So hopefully it'll be better this week without the sound issues. So I'm looking at it this time. Before we start, I want to say or introduce myself to those of you who don't actually know me. So if you are a new subscriber, I am, hi, my name's Rob Stewart. I'm a property investor and a business owner. And over the last sort of 15 years or so, I've built my own portfolio, predominantly in the Northwest. And over the last few years, since COVID, I've been buying and selling businesses. So the community that I'm building here in the channel is all about growing income and wealth through passive investment vehicles, such as property, such as businesses. That's not necessarily being a business owner, but being a business investor. And the great thing about property and businesses is they're very creative. So whoever you are, whatever your resources are, whatever your experience, you can get into property, you can get into business without necessarily being a hands-on person, right? By either creating interesting creative structures to buy businesses and property with, or using other people's money. Okay, and when I work with my private clients, this is what I have my private clients with. Okay, so that's the vibe of me. What we're trying to build here is a community to allow other people to do the same. Okay, so why am I talking about house prices again? I know over the last couple of weeks I've talked about house prices and inflation quite a lot. The main reason for this is when we look at house prices or we look at macroeconomic factors, it's almost like a crystal ball that we can use to make more informed decisions. This is really important because a lot of people get into business, they get into property, they might get into share trading, crypto, and don't really understand what's going on in the big picture. Now, when I got started back in sort of, I bought my first investment property in 2007, just before the market tanked. I lost money on that. And if I'd had a forward-looking, sort of idea of what was going to go on, I probably wouldn't have bought that property. Again, let's go into COVID. When we got into COVID, my portfolio is there, it's running, it's passive. So I started diversifying in some other things and not understanding the macroeconomic factors at play. I made mistakes which cost me money. So the reason I'm so strong on going through data and what's going on in the market is to be able to look at leading indicators. So we've got two sorts of indicators, okay? We've got trailing indicators. We've got leading indicators. Trailing indicators are that rear view mirror to go, okay, this is what's happened. Okay, so when we look at house price charts, those are trailing indicators. What we want to be able to do is look at leading indicators, which gives us a sort of forward-looking insight about what's going to happen. So over the last few years, housing market's been very strong, okay? Very, very strong. It's been difficult to find really awesome deals, if I'm totally honest with you. Now we're seeing a shift. And the reason I'm so keen on looking at what's going on in the house price or the housing market in the UK right now is understanding what to buy, when to buy it, and how to structure your portfolios. Because, of course, there are some strategies that work really well in falling markets. There are other strategies that work really well in rising markets. So in a rising market, you're going to be doing really well if you're sort of flipping, you're developing, because a lot of the profit you make is actually the market going up. And if you look at the UK housing market over the last 2-3 years, I think it's probably gone up since COVID. It's probably gone up almost 25 to 35%. Okay, so actually a lot of your profit has come from a rising market. If you're in a falling market, much more difficult to be able to flip properties, to be able to sort of buy land and build, and you're adding a lot more risk. So right now, with a lot of market uncertainty, personally, I wouldn't be looking at buying things to flip or develop unless you know that you're getting a really awesome deal, right? And you've got enough profit margin in there to absorb 5, 10, 15% falls in the property market. Very often at these sort of times, you might see people land banking, for example, which is trying to buy land, waiting until market recovers and then build it out when you're in an upward market. But of course, when the market falls, it's just like stocks and shares, right? Excuse me. Stocks and shares, you make money when it goes up, you can make money when it comes down. Different mechanisms, but you can do the same in property. So when the property market is coming down, other strategies open up and become much easier, okay? You're going to have much more scope for creative property strategies, creative business buying strategies, because you're going to get a lot more motivated sellers. Whether that's people who you can help who are in financial issue, or whether it's tired and burnt out business owners, landlords, baby boomer generation who come to the end of a cycle. They're in their 60s, their 70s, their 80s. Okay, they've got huge amounts of equity built into the portfolio. They're now seeing things becoming much more difficult for landlords, and they're seeing the market dropping and profit margins being squeezed. And they'll be thinking, right, now's the time to exit. Now's the time to get out. And that's an amazing pool of stock for you to be structuring creative deals, for example. Now, I'm not going to go into creative deals here, but things like lease options, assisted sales, deferment, vendor finance, all these sort of things, which means you can get into property with much less money up front in a much more creative way, or just significantly below market value. We've just agreed a deal in Chester, which is, I believe, is a significantly undervalued property. It's fantastic. It's a mixed-use building. I'm putting a video out. It'll be tomorrow, talking about if you can retire on one deal. By the way, if you want to make sure you see all these videos, make sure you are subscribed, get the little notification on, so when I put a video out, you can get to see the video. I'm going to be talking to you about my first large deal and if it's really possible to retire on one property deal. So I won't go into any more of that, but we secured a deal last week. Mixed use, retail on the ground floor, 4 flats on the top floor, significantly below market value, and it will give a double-digit net yield. So do I care if we buy it and the property price then dips for the next year or so? No, not particularly, because it's going to go into a long-term hold portfolio. So as the market's coming down, we can get deals, hold it over the next 5, 10, 15, 20 years. That's, because the market will reverse again at some point. Let's, be obvious about that. It's going to turn around. Cool. So that's why I do this channel. That's why I do these lives. And I like to do these live updates so we can just get the data out and have a look at the data. So I'm rabbiting on at the moment. So what I want to do, by the way, when you come on, say hi. I can see we have some people on. Say hi. I would like to go into the iPad and have a look at the data that we are presented with. And excuse me, in last week's live, I talked about decision-making bias and how some people have a positive bias, some people have a negative bias, and what we want to have is an objective bias. So positive bias is people go, look, property market is always going to go up. It's never going to crash. And you'll look at mainstream media and see headlines. So our sensationalist headlines, for example, there's a headline last week about Rightmove saying, market's bottomed out. Things are going back up. Average price has gone up £3,000 in February. I can't remember if it's January or February for the Rightmove index. And that is a positive bias article. Then people with a positive decision-making bias will read that and go, cool, we're at the bottom, time to pile back in. And you could be making an incorrect decision by doing that, okay? Because it might just be a blip or you don't understand the data. Negative bias, obviously the opposite. What I want to make sure, I've got some, just want to get rid of that. What I want to make sure is that everybody's working from objective data, looking at trailing and leading indicators so we can make informed decisions. Okay, so let's have a look at the data that we are seeing right now. And the reason I'm doing this live is because we had the UK House Price Index data for January come out last week. And that's, for me, is the gospel of what's going on in the property market. But before we look at the UK HPI, let's look at the other two indicators, or the other two indices, which are the nationwide and the Halifax. So here's the graph of the nationwide house price index, where we can see a very obvious decline in the property market. Now, to explain how these indices work, if you haven't seen sort of an explainer on these before, Nationwide and Halifax are obviously two lenders, and their indices are based solely on their mortgage approvals. Now, that's important to say, approvals. It's not necessarily their mortgage completion rates, because, for example, somebody might get a mortgage approval and then that deal might fall through for whatever reason. Maybe somebody pulls out because they see the market crashing. So it's not an entirely accurate snapshot of the housing market. It's based on the individual lender's mortgage approvals. It also doesn't include any cash purchases. And as an investor who buys in cash, I know that with cash, we're always going to get the better deals. So you're probably going to see more below market value deals go through with cash purchases. They also have various other exclusions. I believe Nationwide doesn't show buy to let as an example. Okay, anyway, Nationwide, we're seeing a very definite drop down as we go into January 23. Now, the one that's kind of confused people a little bit, sorry if I just get rid of this, is the Halifax price index. So this is where a lot of the headlines have come from in the last month or so, saying that the property market has bottomed out. We've got confidence coming back in. We're seeing a bounce. Now, I probably shouldn't say seeing a bounce, because being a bounce means a bounce up, probably come down again. But you can see that month on month, December, January, February, month on month, Halifax are reporting an increase in house prices. Okay. Now, we're just looking at the data here. Objective data. Look at the trends. I always say to everybody, look at the trends of what's going on. The purple line here is the month on month. The sort of teal line is the quarter on quarter. Quarter on quarter, January is the first uptick in 7 quarterly, month on month quarterly drops. That to me is not a reversal in the trend, right? It's a uptick, and it could be sentiment driven. Property markets are very often sentiment driven. Okay. Mini budget destroyed sentiment. Markets really shut down probably for October, November, and then come back after Christmas. You might see a bit of a surge of confidence. People think we're out of it. Headlines of interest rates coming down, and a bit of confidence comes back in. I'm just hypothesizing, by the way. So we've got Nationwide shows a definite drop. We've got Halifax showing a little rebound. And let's now go over to the UK HPI. And this is the one that I really wanted to talk about. Okay, this is the important one. If I can just zoom in on that. UK HPI, so UK House Price Index, is now showing 2 consecutive month-on-month drops. Okay, so we're seeing the top, and it's now starting to peter off. So that's December and January both saw a drop. Now in January, the drop month-on-month was actually 1.1%. 1.1% is a fairly significant monthly drop. In the housing crisis of 2008, I think the biggest monthly drop was about somewhere between 1.5%, and sort of 2%. And that was a complete global meltdown, right? So we've got 1.1% drop in January. Now, again, super important to understand where the data from the UK House Price Index comes from. This is from land registry completion. So we're now seeing the best snapshot of the entire UK. Okay, we can filter it down to areas. We can filter it down to Scotland, Wales, England, etc. But the thing with the UK HPI is it's a massive lagging indicator. Okay, it's a huge lagging indicator. Because of the length of time it takes for properties to go through conveyancing, and because of then the subsequent amount of time it takes for properties to be registered on Land Reg, you could be talking easily 6 to 9 months after going on Land Registry after the deal has been agreed. So when you look at UK HPI in January, we're probably looking at a lot of transactions that were happening in August last year, which is really interesting because we're probably seeing the data before that mini budget. And I think that's interesting. Now, we might not be. Of course, you can get cash purchases can go through very quickly. So there's going to be a mix. There's going to be a blend. There's going to be some that are quite long in terms of conveyancing going on Land Reg. There's going to be some that are quicker. But difference between Nationwide and Halifax versus UK HPI is it's a much bigger lag in the system on UK HPI. So over the next 6 to 12 months, this is the one that we want to watch and see what's going on at, okay? And the other thing to mention, by the way, on this is that all of these indices are nominal prices rather than real prices. Now, what do I mean by nominal prices? Nominal price means it's the actual sticker value. It's what somebody's actually paying. Real prices are inflation-adjusted prices, and these are the ones that we really care about. I'm going to show you at the end a graph of inflation-adjusted property prices. It's so important. We've kind of forgotten about this, and I still, like literally even now, I go on the media, nobody is talking about inflation-adjusted property prices. No mainstream media are mentioning inflation-adjusted, i.e. real-time property prices. Because we're in a high inflationary environment, right? If property price, let's just say property prices are level in terms of nominal terms, i.e. the actual sticker value that somebody's paying, but we're in a high inflationary environment, that means prices are actually in real terms coming down. So UK HPI showing a fall. We'll keep watching this on a month-by-month basis. Right, let's go to the next graph that I think is interesting. So we've talked about the lender indices. We've talked about UK HPI. I want to zoom out a little bit now and look at some macro leading indicators, macroeconomic leading indicators that's going to give us that forward-looking view into the housing market, because this is what we want to base our decision-making processes on. So a lot of people will be going, look, we're probably accepting that we're in a housing market decline. I'm not going to say crash, right? Too sensationalist. Decline. It's coming down. It's peaked. It's coming down. The question is, how far is it going to go? Do you care about real or nominal values, right? And when do you want to make a decision to purchase? Please also don't forget that this channel, I'm talking specifically to investors rather than homeowners. Homeowners, extremely different set of circumstances and different decision-making criteria. I'm talking about investors or developers, so people who are professional property people. So when we zoom out and look at the leading indicators, there's a few things we want to look at. Number one is obviously the house prices themselves, okay? Another one is the interest rates. And for me, a third one is affordability. Affordability is a huge one. Okay, so I want to look at this graph, which is a graph that shows, now this is real term. This graph is actually inflation-adjusted property prices. But it shows inflation-adjusted property prices with spikes when the interest rates go up. So you can see 1980, 1990, interest rates go up, property market depresses. So on a very simplistic term, with interest rates going up, it's going to put pressure on the housing market to come down. Now, when does that pressure actually take effect? It depends, okay? We're not in 1980 anymore. We're not in 1990. And what interest rate actually causes that sort of reversal in property prices? Let's just go super simplistically and say rising interest rates is going to mean property prices are going to come down for the main reason that with interest rates going up, people can afford less. If people can afford less, they can borrow less. If people can borrow less, by default, property prices have to come down depending on where they started with. Okay, again, we have to, it's a complex thing we have to look at, and we have to look at all these factors in, working in tandem with each other and understand what's going to happen. So we can see simplistically, interest rates go up, property prices come down. We have seen over the last year, interest rates are spiking up. So from 0.1 to what are we? We're just about to go to 4.25. Will it go up any further or not? We can talk about the banking crisis another time. I'll put a video out next week explaining the banking crisis. However, a lot of people out there, a lot of commentators saying they're still low in historical terms. 1980, 17%, 1990, 14.8%, it's still only 4.25. Right. It's all about interest rates and affordability. So I'll look, in fact, let's go to it right now. Is this the right graph? If we go to this graph, we look at UK price to earnings ratio, okay, house price to earnings ratio. What this shows is because the market's been going up so much, right, the value of property has been going up in multiples of the average person's earnings, which means people are taking on more debt. So if people have more debt, if they have bigger mortgages, then smaller interest rate increments are going to have a bigger effect. So when people talk about, look, interest rates were 15% back in the 90s, there's a piece of analysis I saw, I don't know how accurate it is, I can't remember the source, a piece of analysis that I saw that broke down objectively using data how interest rates, I think it was 4.5% to 5% now with the current levels of debt, have the equivalent impact of interest rates at 16% or whatever they peaked out at in the early 90s. And that's because people have more debt. So more debt, small amount of interest rate increases causes a lot more impact on people's affordability. So I think this is a really interesting graph because you can see the last housing crash that happened, 2008, right? Price to earnings ratio were, what's that, just over six, so about 6.4 times. The big sort of crash of the early 90s, price to earnings ratio was 5. Right now, and this is, by the way, this only goes to this graph. I couldn't find anything that goes further than this. This graph only goes to Q1 2022. So we've probably got the best part of another 2 or 3 quarters of this upward line here going up. But we have effectively, in the post-COVID boom, shot past that highest ever UK house price to earnings ratio of 6.5. Okay, so we're probably, I don't know where we are right now, probably somewhere between 7 and 8. Now this is average. It's going to be bigger in London, smaller in other places, but we're in new territory here in terms of house prices to earnings. Okay, and that's really interesting because we are starting right now with the highest house price to earnings ratio we've ever seen in anybody's lives, plus interest rates still going up. I'm not going to hypothesize right now if we're going to go up further from 4.25, or if we're going to stabilize and take a breather. I think a lot's going to depend on what happens in the financial system. But my gut feeling, this is not a prediction, my gut feeling is we've got more to go, guys. We've got more to go. That's going to create serious pain for a lot of people, okay? Because they've got all that debt, it's going to be going off. And if you saw one of the videos, by the way, go and have a look at the live I did out a couple of weeks ago, where I looked at a graph of 2-year or fixed rate mortgages expiring in 2023 and 2024. It's about 350,000 every quarter. People who are on sub 2.5% interest rates are expiring every quarter for the next 2 years and going on to either higher fixed rate or variable that's going to be much higher. So this, without a doubt, is going to have an impact on property prices. Okay, so the next one I want to look at is this from the Rightmove report. Excuse me. This again is a fascinating chart. Now I know, granted, okay, this chart is specifically for first-time buyers, so it might well be different, okay, when you look at it averaged out. But it just caught my eyes as I was going through the last Rightmove report. Now, this graph is the average monthly amount spent on a first-time buyer home versus the equivalent rent. So the yellow line is rent. The green teal line is if you're buying with a mortgage. So you can see from March 22 how the cost or the average amount spent on monthly payments for a first-time buyer absolutely skyrocketed during 2022. Okay, and this will be a combination of house prices going up, but also the interest rates going up. So with interest rates going up, people who are not locked into those cheap deals, okay, so they're now taking deals. Maybe they're locking, maybe they're on variable rates. I hope they're locking in 2022. But the cost of lending has been going up. You can see sort of mini budget time where it really spikes, and now it's obviously blown off the top a little bit, but it's still significantly higher than rent. Now, I think this is one of the biggest leading indicators that's going to dictate what's going to happen to house prices, because that is just insane. The amount of extra burden, extra outgoings every month for a first-time buyer, and that's probably going to be reflected across the entire market. Now, when you combine that with cost of living crisis, okay, utilities spiking up, we're just coming out of the winter, it's still pretty cold at the moment, okay, and everything else going up with the high inflationary environment. Real-time wages for the first time, real-time, again, inflation adjusted. Don't look at just normal wages. If you look at normal wage growth, it will be going up. But you need to look at inflation-adjusted wage growth. And the latest data comes out and shows inflation-adjusted wage growth has actually contracted. So we are real-time inflation-adjusted, lower or negative wage growth, which means people's affordabilities are being squeezed like this. Okay, this is crunching people's affordability in a big way. And if people's affordability is crunched, again, as I said at the beginning, if people can afford less, they can borrow less. If they can borrow less, they can buy at a cheaper rate. That's the wrong word. They can only buy property at a lower rate than if it was 2 years ago and had loads of cheap debt and affordability wasn't an issue. Again, if you just do the maths on this, there is, in my view, from a macroeconomic viewpoint and from a mathematical viewpoint, I cannot see how house price can do anything but continue to come down until we reach a level where affordability comes into sync again with this. And again, if I just come out of this and we look at, what do I want to look at? Let's look, excuse me. Let's look at this one. When you look historically at those house price boom and bust and contraction, this one in the 90s was actually huge, right? That's in terms of, again, this is real house prices, this inflation adjusted house prices. That was a deep contraction into the 90s because the prices had to come back down to a level where people could afford to buy again. And of course, don't forget, when we get to that level, it will come down, it'll get to that level again, and then, in all honesty, it'll probably come back up again. That's not a prediction. We could go into, a different sort of economic cycle. Look at Japan, for example. So there's no guarantee we'll go boom and bust, but I would suggest in our society, we tend to forget the lessons we learned and go down that route. Okay, so the last graph I want to show you, and this to me is another massive leading indicator. So remember, we've talked about affordability as one leading indicator. Let's talk about mortgage approvals as a second leading indicator. And when I saw this graph, I was like, whoa, that's significant. So this graph shows the mortgage approvals by month. And let's just have a look here what's been happening since mini budget time. Okay, so month on month, we have been coming down. What's that? August was the highest. August last year, sort of mania, 75,000 mortgage approvals, and then it's dropped off. And look at, this is not just one-off. It's not just a one-off blip. Look at that, January 2023. Okay, we are almost half what we were in August last year. Now, there is a direct correlation between mortgage approvals and house prices. It literally looks right now like the market is grinding to a halt. That, to me, is the biggest leading indicator we've got. The market appears to be grinding to a halt. Now, there is a contra argument here that if the market is grinding to a halt and less people are selling, there's going to be less supply. Supply demand dictates that if there's less supply, it's going to hold prices up. And I think that's a valid argument, certainly for the short term. Okay, but at some point, this is actually showing the demand side potentially. Okay, because this is mortgage approvals. It's not like house sales. This is mortgage approvals. This is people buying. So you're seeing half the amount of people buying in a very simplistic term compared to August last year. So we've got to see what happens with this. We've got to see how the market plays out over the next 3, 4, 5, 6 months. I would say, until autumn, winter next year, because it could be that people are not buying because people go, look, I'm not buying now. We're in a downward market. I'm not buying. And if we then see a spike in supply, because there has been a valid argument that there's been a lack of supply in the market, which is one of the reasons that we've boomed up. Okay, that completely ignores all the things like quantitative easing and all of that sort of stuff and cheap debt. However, if people start struggling, right, and more people are looking to sell because they cannot afford the properties they bought with cheap debt over the last couple of years, that's going to spike the supply side up. And if the demand side isn't there, what's that going to do to prices? It's going to bring it down. So from my point of view, and this is just looking at the data. This is not specifically any predictions, but just looking at the mathematical data. Other than the Halifax, every other trailing indicator shows declines. When you look at the leading indicators in the property market, for me, they are all showing further declines. So the question is, as I said at the beginning, how is this going to play out over the next months and years? And look, the thing with the property market is it's a glacial moving thing. Okay, this is not a property market crash. Does not just happen overnight. It's not like crypto. It's not like Bitcoin, right? It's not even like stocks and shares. You look at the last crisis, probably 2-3 years from peak to trough. I suspect we're going to see something similar. I suspect we're going to see decline for the next, I would say certainly through this year into next year in terms of actual house prices, in terms of nominal house prices, i.e. the actual price. But this inflation, when the budget came out, and I did a live following the budget coming out, and one of the targets that Hunt put out was it one of his targets? I think it was actually what the ONS said. They expect inflation to be sub 3% by the end of this year. And then last month or this month, it's actually gone up. My prediction is it's not going to be sub 3% by the end of this year. My prediction is it's actually very much embedded in where we are, and it's going to be much trickier to get rid of this persistent inflation we're now seeing what mechanisms do we have to get rid of persistent inflation? It's interest rates. Okay, so it's kind of a rock and a hard place. What do? Do we continue interest rates going up to tackle this inflation, which is going to put some serious stress on the economy and on on property markets? Or do we pause this, right, and inflation gets embedded and carries on making everybody's real term wages and real prices devalue? So let me I'm just going to go back one more to one more graph, which is, this is the real time real house prices, so inflation adjusted house prices. And again, this is not up to date now because this goes up to Q4 of 2022. So we're going to probably see an update of this fairly soon for the next quarter, because we're about to come out of the first quarter of 2023. You can see here, right, inflation adjusted house prices are already coming down significantly. So if we go inflation adjusted house prices, sorry, I don't have my pen available because when I'm in present mode like this, I don't have my pen available. If we take where we are at the end of 2022, right, and go over to the left-hand side to the last time it was that low, we're talking Q1 2014, right? So right now, real-time inflation-adjusted price is the same as the beginning of 2014, which is interesting. And look, this trend line, okay, again, trend lines are really interesting. With the trend line, you can see right, this is obviously the crash. The crash comes below the trend line, right? And then inflation-adjusted house prices come off, and they actually bounce off the bottom of the trend line. So it's almost a rejection of that trend line of inflation-adjusted house prices. Okay, and then we've gone up, we've come up. It's not even got back up to the trend line before we've had this big reversal. Okay, so I suspect in terms of real-time house prices, which is extremely relevant, real-time house prices, we're in for a deep and probably longer correction than anybody thinks. I might be completely wrong. Always possible that I am completely wrong. These are not predictions, it's just a hypothesis. Okay, awesome. I hope that's been useful. That is a snapshot of where we are with the property market with the latest UK HPI data. Just as a recap to that, UK HPI showed the last set of data, 1.1% decrease in overall UK housing prices. That's a second consecutive drop from UK HPI. And because that's a 6 to 9 month lagging indicator, I think that's really starting to give us a true picture of where we are. I hope it's been useful. If you've got any questions, please put them in to the comments. I will take questions from you. I also hope that all of the tech has worked all right today. For those of you who are on, and those of you who are watching on the replay, I am looking after Easter to run a week-long live challenge, both on the the Assets for Freedom Facebook group and on this YouTube channel. So I go live every day to do a property sourcing challenge. So what I want to do is show everybody who's specifically property orientated how I go about sourcing property, because I'm deep. By the way, there are some great opportunities out there at the moment. If you are a property investor, if you're looking for investments that's going to take you through the next cycle. By the way, when we look at cycles, right, let's just flip back to this. This is important. If we look at this graph, and I'm just going to stick on this graph, just ignore the red line. If we look at this graph, when's the best time to be buying property? Okay, best time to be buying property is here, right? So what's that? Mid-90s. Because if you bought in the mid-90s, you're going to do very nicely. Next time to buy property is sort of 2012, the next dip. If we had a crystal ball, you'd want to know where the bottom of the market is. You buy as much as you can, right, at that point in the market. And then the next cycle that goes up, it's going to clearly raise the value of your portfolio. Now, whether you then want to, sort of exit, refinance, buy more stuff, is kind of up to you. With property, with anything really, I'm not going to sit here and say try and time the bottom of the market. That's stupid, right? You're never going to time the bottom of the market. You're never going to time the top of the market to sell. If in the 90s on the way down, you were selling anything, I would say from 1990 onwards. Yes, it dips down, but then it goes back up and then it exceeds. So property is a long-term game. If you're looking next 5, 10, 15, 20 years, for me, property is all about generational wealth. It's all about creating a portfolio that I can hand over to my kids when I'm gone a long time in the future. That's my aim, of what I'm doing in property. Okay, yes, it provides my lifestyle now. It provides a very nice lifestyle, hands-free, passive income from a portfolio. But the real play for property is generational wealth. Okay, think about that when you're building your portfolio. So of course, we want to, when the market's coming down, which it is now, okay, it's going to create some opportunities. And for me, when we go through these cycles, when you're coming to the end of the market, you don't want to be buying right at the top. You don't want to be buying just when it's coming down, but as close to the bottom as you can get, coming down or going up, to fill your boots then, because the next cycle is going to take it up. So we need to understand that. I'm out buying big time. I say that. We are buying. We're doing a lot of building our pipelines up, building pipelines of properties, building our pipeline of investors up to fill our boots. I would say over the next 2 to 3 years is the next phase, next stepping stone, if you like, of building my own portfolio. While the opportunities are like this, I suggest if anybody else is in property or asset building, you want to do the same. It's a good time to be getting out there and building your pipelines, because pipelining property means you're going to find the deals in, the best deals. You find a property, you're going to buy it 3, 6, 9, 12 months after you see it for the first time. So you want to start building that pipeline. So what I'm going to do is I'm going to run a sourcing challenge the week after Easter, so Tuesday after the bank holiday, every day live. I'm going to show you how I do it, okay? How I do the sourcing. I want you to go out and do the same. If you would like to be involved in that sourcing challenge, put something in the comments. Say, yes, I'd love to be, or put a thumbs up or whatever. Make sure you're subscribed to the channel so I want to put the details out. You get to see those lives every day, and please, do pop on and get involved in that challenge. What I'm going to do is I'm going to pick one person who is a subscriber, find their area, and effectively go, if I was starting from scratch in this area of the country that I've never been to, how would I go about sourcing property here? How would I go about finding deals that I would like to buy, or how would I monetize those deals? So feel free to get involved in that. Right. If anybody's got any questions, I've been rabbiting on long enough. I probably should condense these live streams. If you've got any questions, put them in now. Otherwise, I will bid you adieu. Tomorrow, we're getting a video out about can you retire from one property deal. I'm going to be going through my first large deal with you, breaking that down so you can see the figures and how I went about doing that. Next week, I'm going to put a video explainer out about the banking crisis and how that affects your decision-making process. Okay, all looks good. Team, it's been a pleasure. I look forward to continue building this community. Please do get as engaged as you can do. And I will see you probably next week.